Hey, we're going to talk about the Oliver Velez method today. And what I ended up doing is I went ahead, went through the manual, made some notes, and then fed it to, AI. Had AI really create a podcast about, hey, what we really need to learn here in the manual. And also, like, hey, what's the key plays? And it basically titled it the Oliver Velez Method. We're going to go over the podcast. I may interrupt, I may not. I might just sit here and watch it with you. But this is just some additional information. Hopefully, it helps. I thought it was a good listen.
Okay, let's kick things off. Today, we are doing a deep dive into a document that makes a pretty bold claim. It says it's the path to professional trading.
It's the trader manual from iFund traders, and it's all about Oliver Velez's methodologies. And you're right; it starts with a surprisingly philosophical punch.
I was not expecting that. You think finance, you think charts and numbers, but it starts with this almost Zen concept.
It really does. The very first idea is that every single transaction, every single one, is inherently neutral.
Neutral. That feels wrong. I mean, everything you hear about the market is emotional. It's crashing, it's soaring, panic, greed.
Exactly. But that's all the noise. The core idea here, the hook for this whole system, is that for every trade, there's a buyer and a seller.
Right.
So if a stock trades at $50, someone was completely convinced it was a great idea to buy at 50.
Yeah.
And at the exact same moment, someone else was just as convinced it was a brilliant time to sell.
So the transaction itself doesn't have an opinion.
None. It's just an exchange. It's a point of agreement on price between two people who completely disagree on value.
So where does the chaos, the movement come from?
It comes from what happens next. Who was right? The manual frames the market as a battlefield. You've got the bulls, the buyers, versus the bears, the sellers.
And this manual is the decoder ring.
It's the decoder ring for figuring out who's winning that battle, minute by minute.
And the mission here is huge. It talks about getting away from gambling, learning to trade for life.
It's all about making it a profession. You know, a gambler hopes, a professional has a plan and executes. And to do that, you have to stop seeing charts as just random noise. You have to learn the market's alphabet.
I love that phrase. It implies there's a language here, something you can actually learn to read.
That's the frame. Velez says there are only 13 types of bars the market can possibly make. That's it, just 13.
Only 13.
If you learn those 13 letters and the grammar, the time frames, the moving averages, you stop guessing. You start reading the story the market is telling you.
Okay, let's get into that grammar. The anatomy of the battle. The manual places this huge emphasis on the open. Why is the opening price so important?
Because the open is the starting gun. It's the neutral line for whatever time period you're looking at, whether it's a day or just 5 minutes.
And the rule is simple.
Incredibly simple. Prices trading above the open, the bar's green, the bulls, the buyers, are in control. Trading below the open, it's red. The bears are winning.
It feels almost too simple. Above is good, below is bad. Can that really be the foundation for a career?
It can, because it removes all the guesswork. But here's the stat that makes it actionable. The manual claims that 82% of the time, a stock follows through in the direction of the solid color of its last bar.
82%.
That's the number. So if you see a solid green bar, the odds are just overwhelmingly in your favor that the next move is also up. You're not predicting, you're just betting that the winner of the last fight will win the next one too.
Speaking of clear winners, let's talk about the biggest signal in the book, the elephant bar.
Ah, yes, the elephant bar. Or wide range bar. It's all about size.
Yeah.
It's a bar that is just dramatically bigger than all the recent bars around it.
It's a statement.
It's a huge statement, just massive conviction. It means the big money, the institutions have shown up, and there's a great line in the manual for spotting them.
What's that?
It is either there or it is not. They don't hide.
Right. If you have to squint or get out a ruler, it's not an elephant.
Exactly. It needs to be obvious from across the room. But, and this is huge, but context is everything.
Right.
Just seeing a giant green bar isn't an automatic buy signal.
This is where that igniting versus exhausting idea comes in. This feels like a major trap.
It is the trap. If an elephant bar shows up right at the start of a move, breaking out from a quiet sideways base,
Yeah.
that's an igniting bar. That's the engine starting.
That's your entry signal.
That's your
Yes,
signal.
right.
By the way, if a stock has been trending up for a while, it's been climbing and climbing, and then you get this massive vertical elephant bar. There's probably an exhausting bar.
The last gasp.
The last hurrah. It's the panic buying from everyone with FOMO. They all jump in at once, create this huge green bar, but there's nobody left to buy after them. That's very often the top.
And that's how amateurs get crushed. They buy the top because it looks so strong.
Please, sorry, Sam.
Okay, so we have the size of the bar, but the manual also drills down into the levels of control. It's not just green or red, it's how green or red.
Right. This is the nuance. A bar is like a snapshot of a tug of war. So absolute control is a solid colored bar with no wicks at all.
No wicks.
0. If it's green, it opened at the low and closed at the absolute high. The bulls gave up nothing. Pure, undeniable strength.
And then there's full control, which is just a little bit off the extreme, still very powerful. But I found good control fascinating. The manual calls it a squat before a dancer's leap.
It's a beautiful image, right? Good control is when the price pulls back a bit from the high, but the bar is still mostly solid colored. Most people panic there.
Yeah.
They see it pull back and think, oh no, it's reversing.
But it's not weakness.
Not at all. Velez calls it the squat. It's the market pausing to gather energy for the next push. It's potential energy.
But there is a point where that pause becomes a real problem. That's weak control.
Right. When about half the color gets erased.
Yeah.
So you have this long wick in a smaller body. Now the dominant side is in trouble. The other team is fighting back.
Yeah.
And they're gaining ground.
And this all leads to what seems like the single most important rule in the whole text. The 23 rule. The turning point.
This is the line in the sand. If 2/3 or more of a bar's color is erased by the wick, control is officially lost. That 82% follow-through statistic, it's gone. It's negated.
And you shouldn't need a calculator.
No, absolutely no math. It has to be an instant visual cue. You look at the bar, you see the tail is way bigger than the body. You know the battle is over. You get out. It takes the emotion completely out of it.
And if 100% of the color is erased,
that's totally over. A massive, crushing defeat for the side that was trying to push. If the bulls push price all the way up, and by the end of the period, the bears have shoved it all the way back down, that makes a topping tail. It's a huge win for the bears.
Okay, so that's the battle inside one bar. But you mentioned there are only 13 bars in this whole alphabet. We've talked about the colored ones. What about the draws?
Topping
The ones
tail.
with no color.
Right. These are what some people call dojis. The open and the close are at the same price. But the manual makes a really key point. Even in a draw, somebody wins.
How can you have a winner and a tie?
It's all about the tails. The story of the bar. Let's say a bar opens, price shoots way up, and then it gets slammed all the way back down to close right where it started.
So the body is just a flat line.
A flat line. But that's a topping tail.
Yeah.
The bears completely erased all the bulls' progress. That's a bearish bar. It's a win for the sellers.
And the opposite, a bottoming tail, where it drops and comes all the way back up. That's a win for the buyers.
Exactly. It's about who had control at the final whistle. It's a much more dynamic way of looking at a chart.
Okay, alphabet learned. Now for the map. The manual is very specific about which time frames to use, and it splits them into income generators and analytical frames. Let's talk about the income generators first.
Yeah, this is for what they call high-octane ATM daily income. This is not long-term wealth building. This is about generating cash flow day in and day out. And the number one staple is the 5-minute chart.
Why 5 minutes? Not 1, not 15.
It's the Goldilocks zone. The 15-minute can be a bit too slow. You might miss the move. The 1 minute is just, it's pure noise. Too many false signals.
Too frantic.
Way too frantic. The 5-minute is the perfect balance. You get enough signals to stay busy, but it's slow enough that you don't overtrade and just churn your account.
But the smaller time frames do have a role. The 2-minute is called the X-ray.
Yes. So maybe the 5-minute chart looks a bit messy,
Yeah.
or the best entry point seems too far away, meaning your risk is too high. You could drop down to the 2-minute to look inside the stock.
To get a clearer picture.
For a finer entry, to tighten up your stop loss and reduce your risk.
And the 1 minute, the X-ray of the X-ray.
That's for surgical precision or for scalping. The manual says to use it during the midday doldrums.
Lunchtime on Wall Street.
Right, when volume dies and the market goes flat. You can use the 1 minute to scrape out tiny profits while everyone else is bored. But it comes with a big warning. It is noisy and way less reliable.
Okay, so those are the how and when. But what about which direction to trade? That's where the analytical timeframes come in.
Correct. You never just look at a 5-minute chart in a vacuum. You need a bias. You have to know which way the major wind is blowing before you put up your little sail.
You need the big picture.
The daily chart is step 1. You check this before the market even opens. Is the stock in a general uptrend or downtrend? Is it overbought, oversold? This sets your game plan. If the daily is bullish, you are only looking for buy signals on your 5-minute chart.
You just ignore the sell signals.
You completely ignore them. There are low probability trades against the primary trend.
Then there's the 60-minute chart, which the manual says is almost never for actually placing a trade.
Correct. It's for finding major reflection points, big reversal areas. It's like looking at the long-range weather forecast.
And finally, the 15-minute.
The 15-minute is the core analytical frame. It gives you the truest trend for the day. It filters out a lot of the 5-minute noise. In fact, the text says that trades on the 15-minute are often the cleanest and truest of all. If the 15 is green and the 5 is green, you've got alignment.
That's your green light.
That's when you strike.
So we have the letters, we have the maps. Now for the tools, moving averages. And Velez seems to treat them like characters in a story.
He really does. There are 3 main ones: the 8, the 20, and the 200.
Let's start with the Holy Grail. The 20-period moving average. Why such a lofty title?
He says a chart isn't even valid without the 20 AMA. It's that critical. It serves 2 main functions. It's a magnet and it's a median line.
A magnet.
Yeah, price just can't stay away from the 20 on for very long. If a stock shoots way, way up above it, it's like a stretched rubber band. The tension builds, and eventually it has to snap back to the 20.
So you shouldn't chase a stock that's really far from it.
Absolutely not. It tells you, don't buy here, it's too extended. And the main rule is simple.
Color change.
Trade with the 20 on, never against it. If it's rising, you look for longs. If it's falling, you look for shorts. Don't fight the Holy Grail.
And then there's the granddaddy.
The 200 on.
The 200. This is the big one. It's a major line of support and resistance that the big institutions all watch. The market treats it with utmost respect, as the manual says.
It's a psychological level.
It is. A falling stock will often stop dead on the 200 and bounce hard. And it's most powerful when it's flat, when it's horizontal. Then it's like a brick wall.
I want to touch on this idea of states you mentioned, narrow, wide, and neutral. This feels like it's all about timing. This is the real secret sauce for finding those explosive moves. A narrow state is when the price bars and all the moving averages are coiled up, bunched together really tight. The market is quiet.
Like a compressed spring.
Exactly like a compressed spring, and the manual is clear. The most explosive fluid moves erupt from these narrow states.
So you want to find the quiet stocks.
You want to find the quiet ones. The mistake everyone makes is they chase the wide state when the stock is already soaring miles away from its moving averages. It's the highest risk time to get in. You want to be there in the narrow state, waiting for that igniting elephant bar to kick off the whole party.
So if we put this all together, it really is a system, a checklist.
It is a checklist. Let's synthesize it. It's really 4 steps. Step 1, you check your analytical frames, your daily and 15-minute to get your bias. Bullish or bearish today.
Okay.
Step 2, you go to your 5-minute chart and you hunt for a narrow state, that coiled spring. Step 3, you wait patiently for the signal, an igniting elephant bar or a clear color change that agrees with your bias.
And step 4 is managing the trade.
Right. You manage it with the control rules. Is the bar staying strong? Or has it lost 2/3 of its color? The second it hits that 23 rule, you're out. No questions asked.
It's a rigid structure for something that feels like total chaos.
That's the whole point. You stop trading based on feelings and you start executing based on clear visual signals.
Yeah.
The chart tells you exactly what to do.
I want to leave our listeners with one last thought here. We started this by saying that every trade is neutral. The market itself is neutral. But when you're in a trade and it's moving against you and you're losing money, that feeling of mental neutrality is incredibly hard to hold on to.
It's the hardest part of trading, without a doubt.
Yeah.
And this whole system, the 13 bars, the kind of 3 rule, it's designed to force you to stay objective. But the real question is, can you trust what your eyes are seeing on the chart more than what your gut is feeling about your wallet?
That's a very tough question.
It is. The system works because the chart doesn't lie. But it only works if you're willing to listen to what the chart is telling you, especially when it's telling you, you're wrong, get out.
The system is there to manage the chaos, but the real chaos isn't on the screen.
It's between your ears. That's the real battle. The bulls and bears are the game, but you versus you, that's the war.
Always.
Always.
So, next time you pull up a stock chart, try not to just see the price. Try to spot the elephant in the room. See if you can tell who's really winning the battle. Thanks for listening to this deep dive.
Happy trading.
So that was the podcast we made with AI. I thought it was pretty good. Wanted to share it. Definitely gave some insider information, but I think it's just proof that this system works. It's definitely worth giving I fund traders a try, and I'd say Oliver Velez and the whole team over there is God sent. So here's just a gift for this holiday since the market's closed. Hope you have a wonderful time off. Enjoy yourself. Happy trading, and we'll be